Bowie Bonds. You remember David Bowie? Created in 1997 by David Bowie and banker David Pullman, Bowie issued asset-backed securities tied to future royalties from his music catalog. 25 albums, 287 songs. Investors got paid from royalties generated by streaming, radio, and licensing. Bowie received $55 million upfront in exchange for assigning royalty income to bondholders for 10 years. Sounds like a good deal to me. How do they work? An artist or estate bundles songs, a catalog. Future royalties from that catalog are projected like cash flows. Bonds are issued to investors who buy the right to those future royalties. Investors then earn returns from royalty income instead of dividends or interest. Quite a novel idea at the time.
David Bowie, the music of the rock icon, was no doubt cutting edge, but the British crooner's originality extended far beyond the music and fashion worlds into the financial world. In 1997, he, with the help of investment banker David Pullman, innovated an unusual marriage between rock music and Wall Street by issuing bonds backed by future revenue of the 25 albums he'd recorded before 1990. The Bowie Bonds, as they were called, made him the first musician to securitize the royalties from his catalog, which, unlike many artists, he fully owned. Pullman told the Wall Street Journal that Bowie at one point was looking to sell his songs, but he then responded favorably when Pullman suggested securitizing the royalties by directing the future stream of earnings from his first 25 albums into a segregated financial vehicle, then using it as collateral for a bond, signing the rights away to his music, but only temporarily. The first of its kind bond issue produced a $55 million windfall for Bowie. The bond issue provided a model that was later emulated by other music icons looking for ways to pull value out of their own catalogs amid a late 1990s wave of music sampling and licensing of old songs for TV and film. The artists who followed Bowie's bond model included James Brown, Ashford and Simpson, Marvin Gaye, and the Isley Brothers.
Where can you buy them? Bowie's original bonds were sold privately to institutional investors like Prudential Insurance. Today, retail investors typically can't buy directly, but you can invest in public companies that own catalogs like Universal Music Group or Warner Music. You can buy shares in royalty funds like Hypnosis Songs Fund or Round Hill Music. And some fintech platforms like Royalty Exchange let individuals bid on specific music royalty streams. What investment banks are doing are big banks and private equity firms like Blackstone, Apollo, KKR continue to pour billions into catalogs. They see music royalties as uncorrelated assets, steady cash flows not tied to stock market swings, and banks securitize catalogs the way Bowie did, then resell slices to pension funds, insurers, and wealth funds. Top catalogs are limited. The Beatles, Bruce Springsteen, Bob Dylan, Stevie Nicks have already sold for hundreds of millions. Rising demand has pushed catalog prices to 20 to 30 times annual royalties. Smaller catalogs exist, but they're riskier, less predictable revenue. So there's a scarcity issue for high-value catalogs. How do people make money? The bonds and funds pay out based on streaming, radio, film syncs, ads, video games, TikTok, virality, the appreciation. If a catalog becomes more valuable due to rising streams or licensing, the bonds or fund shares rise in price, and resales. Private equity firms buy catalogs, securitize them, and resell them in parts to other institutions at a markup. In short, Bowie Bonds pioneered the idea of treating music catalogs like real estate, securitized cash flows. Today, Wall Street has scaled it up, turning songs into investment assets for big institutions. Let me know your thoughts.